Good morning, I'm Chris Beach, and welcome to Charting the Markets on INT Live. And it's a better morning all round for risk assets, particularly in stock markets. Not a great finish yesterday on Wall Street, but there were signs of strength in tech stocks, which is always an indication that maybe something is shifting sentiment-wise. The last few days have seen equity markets really come off the boil after their strong gains in almost all the way through November. And that began to ease a little bit, I think. You can call it exhaustion, call it profit taking, but it seems to perk up overnight in Asia. We had a very solid performance for the Nikkei, for the ASX 200, both rising by more than 1%, the Nikkei by over 2%, helped mostly by a weakening of the yen. Chinese markets, though, continued with poor performance, barely managed to eke into positive territory, sitting at 5-year lows in some cases. So really a struggle for those markets. But overall, you've got a strong start today in European markets as well, and US futures looking up as well. Nothing really in terms of news flow to drive it, but overall, the broader backdrop, I think, continues to suggest that we have further gains in store for risk assets. Central banks now, while they continue to leave the door open for rate hikes, are very much in pause mode. Now, we had the Australian Central Bank yesterday leaving rates unchanged, and today we get the Bank of Canada, which is expected to leave rates at 5%. So not the world's most important central banks, but still adds to the view that central banks are mostly done with their hiking efforts for the time being. So now if we're looking to the rest of the day in Europe and in the US, it's not that much of a busy day, but it's the Bank of Canada decision, as I say, at 3 p.m. is the main thing to watch out for, and a Canada PMI as well, and weekly US crude oil inventories. But so far, not a bad morning for risk appetite, I think, and was starting to reflect expectations that we might see further gains into year end, even after the very strong performance for indices seen over the past 6 weeks or so. But starting with the indices, beginning with the FTSE 100, currently trading at 75.11. Of course, this is one of this year's laggards, really. If we look at the year, almost the whole year now in place, you can see how the great hopes of January and February have fizzled out for this index. Where you get the DAX hitting a record high yesterday, and the Dow really closing in on their record highs from about 18 months ago. And Nasdaq doing a similar thing. For the FTSE 100, even the highs of September and October are still about 200 points away. So a bit of a struggle for this index. It has, of course, rallied off the lows and from the end of October, and that's the key thing over the year since March. Every time it gets to around 7,300 down to 7,240 or so, it finds buyers. A classic example of where support is more of a zone. It's not a single line, because you can see we have days where it repeatedly either drops through the zone and then there's significant volatility around those lows, but then it does eventually rally. But for whatever reason, it dips into 7,300 or so and then bounces. What happens next is, of course, the problem, because if you see here, we've got trendline resistance running through from the record high in February for the index, up above 8,000, that magical level that the FTSE did manage to hit this year. But that resistance level, trendline resistance, has capped gains, and you've had more or less lower highs, certainly one in April and into May, and then you had lower highs in July and August and October as well. So the problem for the index is, yes, it's rallied off these lows, but now we're targeting first the 200-day moving average, and then something around 7,600, where we will then get back to that trendline resistance from the February highs. If it goes above that, if it closes above there, it then really has to go and stay above 7,700 to establish a more potentially positive outlook into the medium to long term. But for the moment, we are just below trendline resistance. It's not great for the index that we're below the 200-day moving average as well. It tends to be the line in the sand, really, for further decline. So anything maybe that if we fail to get back above and hold above 7,600, we're very much in lower high territory, and lower high below trendline resistance maintains that negative view. We are supported by trendline support from the end of October. So if it could go back towards there, maybe down to 74.30 and then continue to rally. But it closed below 7,400, we'll see it break trendline support, and then potentially we move back once again to this support zone for around 72.80, really, I suppose, is the line in the sand there for that market. Moving over to the DAX, absolutely stellar performance for this market over the past 6 weeks or so. And this is an illustration of the view I always had, that once the DAX really wants to rally, it does not stop. It's a very popular market with clients. It can be quite volatile. When it wants to move in one direction, it really does. And that's exactly what we've had here. From the end of October, the last week or so, down at 14,600. Again, that was March support for that index. Off it goes. And it's now surged through that summer record high. Really, it's a very healthy sign, I suppose, for the index that while we did see a big drop during the course of July to October, we've recouped those gains in the space of about a month, which is a reverse of what we normally see in markets. Usually markets fall 3 times faster than they rise. This time, the DAX has risen 3 times faster than it fell over the summer. All those losses recouped back to where we were in a very impressive space of time, really. So clearly, I think this now puts us back on a bullish footing, really. Although you would not be forgiven, you could be forgiven, I think, rather, sorry, to say we need some sort of pullback here, because it just looks dreadfully overextended. That yawning gap between the price and the 200-day moving average, 5.6%, is a sign maybe that at some point that needs to close. Probably by a combination of the price coming down and the moving average moving up again. But we've not had a pullback here at all over the past 6 weeks. It's been almost a straight line move, a couple of days to the downside and then off again. So that's why the DAX, like the Dow, actually, I was saying yesterday, the size of the rally over the past 6 weeks means it's not that we can't see further gains into year end. It's just that it might be quite difficult, really, to expect it to stage a Santa rally into the end of December. It's always possible. It's what history usually teaches us to expect. But you might argue that maybe we've already had most of that rally and it might just consolidate into year end. But for the moment, the buyer's still firmly in charge. And you could have said the same thing maybe at 16,000 a couple of weeks ago, and we find ourselves nearly 600 points higher from there. So it's best not to argue with momentum when it's clearly showing in one direction. It definitely is here for the DAX. The buyer's firmly in charge. And we sit here happily for the moment this morning at record highs. And then looking at another one of the mixed performers, I think, of the 3 indices we're looking at this morning, the Russell is the middle one, really. The FTSE is certainly the weakest, the DAX by far the strongest, and the Russell 2000 very much the middle child of this one. Not a great year, not an atrocious year, but not a great year. We've rescued it from the lows of October, which was right back down to support from last year, September last year, around 1650. And it's, again, very, very strong moves. 2 huge days. The 14th of November, we gained 6% for that index. And then on Friday, we were up almost 3%. So small caps very much out of favour over the past year or so. And unsurprisingly, people piling back in again on signs of life. So that's why we've seen this finally break above the 200-day moving average again, back above the 100-day. And maybe we'll start to see it just consolidate in the shorter term. But overall, that's another solid sign that we could see more gains with the price action here. Initial resistance levels to the upside, 1920, say the early September high. And then if we're looking for the longer term, up towards 2000 here, really. For this index, support lies around sort of 1815. So break below that, break below 1800 could send a more negative message, because I suppose with the Russell, like with the FTSE, we're still risking the creation of a lower high here. Turning to FX markets, not too much in the way of news this morning, but the pound continues to drop below 126. The key thing in the past few days has been the really strengthening of the US dollar after 2 months or so of sustained weakness. And that's leading to some interesting moves across the board here. You're seeing the pound drop back for 127 against the dollar. Again, still substantially up on where we were in mid-October, and a very different view. The price being back above the 200-day, back above the 100-day, and also getting back over 124 was a very solid sign that maybe we're back on a move to the upside here, because the Fed is now not increasing rates anymore. Now, the Bank of England might also move in that direction, so it is a tough one to call, but certainly for the moment, from price action perspective, the buyers seem to be in charge. Making some of a pullback here, perhaps down towards the 200-day moving average. And if you're looking maybe for trendline support, then we'd have to wait for a move back down towards maybe 124.50, maybe even 125 to see if that holds. Just seeing some profit taking creeping in at the moment on this. Don't forget, next week is the big one for FX markets, because we've got the Fed, the ECB, and the Bank of England, all in the space of about 48 hours. In fact, less than that, really, 24 hours. So it's going to be quite an interesting one for currency pairs generally, but the cable pound against the dollar, one of those ones definitely to keep an eye on. Strengthening the dollar means that dollar yen is trying to establish what looks like a higher low, I think, really. Still in an uptrend since the beginning of the year. It's been an absolutely stellar year for dollar yen. Started off poorly, but found a low down at 128. And here we are up at 150. So an absolute barnstorming performance for the currency pair. Again, it's not surprising if you think what I was saying with the DAX and we're waiting for a pullback. This is the kind of thing we might see repeated, these chart patterns here. You've got this big move to the upside. It starts off very rapid and then gently slows down, but continues to move higher. And then you get the pullback. But already you're starting to see buyers emerge, and that's definitely one to watch. I think just the way I'm looking at it, you've got a rising trend because you've got the moving averages all moving higher, the price staying above most of them for most of the time, but inevitably the pullback sees it weaken and takes it back down to maybe the lows of the last couple of months. Already, though, starting to see signs of strength. You get a bullish MACD crossover similar to what we had here. Remember, of course, the MACD is lagging, so it will not catch the beginning of the move, but it does then perhaps signal that the buyers are in charge once again. So if maybe we get a close back above 148, you can argue for then a fresh rally towards 152 and the highs from the 13th of November, which inevitably will bring out talk of intervention by the Japanese Ministry of Finance, but we'll cross that bridge when we come to it. For the moment, the buyers are trying to halt this pullback in dollar yen. And Bank of Canada decision day, I'm as excited as you are, I'm sure, but they're expected to leave rates unchanged at 5%. Again, here you can see the dollar strengthening against the Canadian dollar, partially because of the weakness in oil prices. The Canadian dollar, to an extent, is an oil currency. And so the weakness in oil has really knocked back the Canadian dollar as well. Again, despite the pullback of the last month or so, it looks like we could be still establishing a higher low for this one, which is simply to say the low here at 135 remains above the low from the end of September. And let's keep these things nice and simple. So you're still seeing an uptrend, more or less. It's taken quite a bit of a knock over the past month, but it might yet revive. And you're getting a close perhaps above 136. If the Bank of Canada is slightly more dovish to say that could probably give this currency pair a push to the upside once again. And that's definitely something to keep in mind with the expectation that this is a higher low would obviously be reversed if you get a close back below, say, 135. And then turning to commodity prices, it's been quite the week for gold. New record high and then straight back down again, back below trendline support from the mid-November low. I wouldn't really say it's the end of the rally, because when you have such a big move to the upside, it's not surprising that you get the fabled profit taking. It's always a line analysts deploy when they're not sure why something has moved, but it makes sense to say a lot of people would have been long gold and they closed out their positions as it reached a new record high. So you have seen some weakness creep in, but certainly we're still firmly up on where we were in mid-November and very much up on where we were at the beginning of October. So the buyers generally in charge on this one. Some short-term declines maybe towards 2000. Always an interesting area to watch for gold. Gold loves round numbers like 2000. So maybe we'll see a battle emerge between buyers and sellers around there. But for the time being, it looks like we've still got some trimming of gains to be done in gold prices. And then finally, turning to WTI, I think is one we're going to look at this morning, rather, just to keep an eye on this one, sitting at its lowest level now since the beginning of July. It continues to see weakness, and this is the fallout from the OPEC decision last week. As I was saying yesterday, with the cuts, they really just said, "Oh, it's been voluntary cuts," which the market was not happy with, really. And as ever, is the 200-day moving average. Always good to keep an eye on it. You can see how in July it was an interesting area of resistance, and then it broke above it, and that really sort of set the seal on a change of trend here. It looks like the same thing has happened here in reverse. You had a break below the 200-day, attempts to get back above it, then failed, and now we find ourselves really seeing fresh losses. So it seems remarkable that we're talking about this again, but we're back headed towards the 68, 67 levels that we saw over the course of the summer for crude oil. That's the next area of potential support for WTI, at least. I'm not saying it could get there, but it's one to watch in the near term as an initial downside target. And certainly with the rejection of the 200-day moving average last week, and indeed early in November, it looks like the sellers are firmly in control. And that suggests that maybe even as overstretched as it is the downside, we have some more losses to come. Don't forget it's weekly crude oil inventories today as well, so there might be some volatility around that. So for the rest of the day, as I say, it's 3 p.m. the Bank of Canada rate decision, the first thing to bear in mind. But before that, you get ADP payroll numbers, the precursor to non-farm payrolls for the US at 1:15 p.m. Expected to see, again, a slowing increase in the rate of job creation there as the US economy maybe begins to show some signs of weakness. And then we're expecting the Dow to open around about 40 to 50 points higher from yesterday's close. But that's it for me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.